Good morning, good evening, everybody, wherever you might be joining us from. Welcome to tonight's webinar. My name is Igor Ivanovsky. I am the founding member of MrTOPTICK.com. We work with people just like you, retail investors, helping people become great option traders. We also run several option trading services for swing trading and income trading. And if you want to find out a little more information about that, you can go to our website, MrTOPTICK.com. This is not going to be a 10-minute presentation followed by a 45-minute pitch to buy any of our services. So I just wanted to put that out there. If you do stick around until the end, we do have a special offer for our directional trading service, Active Trader Pro. The goal for tonight's presentation is to give you an insight about how options are priced and what drives the price tick by tick, hour by hour, and day by day. I am joined today by one of our traders, Alan Weiss, who is not only a professional options trader, but also a former market maker on the floor of an American stock exchange. With that said, Alan, I'm going to turn it over to you. Let's dig right in.
Thank you, Igor. Appreciate it. So I decided to call this presentation Options Hacks. I wouldn't really say they're hacks that we're going to be talking about. It's just that there are some options pricing lesser known facts, lesser known concepts that I'm going to present to you. I have been a trader for about 35 years. I started in 1986, and I was a market maker on the, as Igor mentioned, on the floor of the American Stock Exchange for about 8 years. So I'm going to share a little insight with you guys about what that means, to be a market maker and how, market makers help or affect you as retail traders. I was also a securities attorney. I'm still an attorney licensed in the state of New York, but I'm really a full-time trader. And that has always been my bread and butter is trading. When I was in college, as you can see on the screen, I went to Tufts University, and an options arbitrage firm came and interviewed there, and they brought a pamphlet which was very intriguing to me. And I kind of decided there on the spot that this is something I could actually do for a living. This is fun. I can incorporate my math. I have a little bit of a mathematical mind, but don't let that affect you at all, because the things I'm going to talk about don't necessarily require you to be extremely well versed in math. Now, I put this slide in just to let people know, yes, you can print up this slide and it might be of some use, but it's really more of an outline. And what you'll really learn from this presentation is by learning, listening to what I have to say, and we will be open to questions. You're welcome to, post your questions on the chat, and Igor can help me sift through those if it's difficult for me to do that while I'm speaking. And hopefully we can answer your questions. If I'm unable to answer a question, then I'll just tell you I'm unable to answer the question. Usually I can, and again, it depends on your trading level, which is something we're going to get to in a minute. Okay. Now, before we discuss what determines options prices, I'm just going to send out a quick poll to you guys just to see where you're holding, what kind of experience you have in trading options. So, and that'll just help me kind of tailor the presentation a little bit. So if everyone can just take a minute to choose an answer to this poll, so I know, have a better idea of who we're speaking with. Okie doke. So hopefully everyone has responded to that. So it seems like it's kind of the mid range. It seems maybe it's a third. Some of you 0 to 1, some of you 1 to 3, and some of you 4 or more years of experience. So I think that's fine. This presentation is better for people who at least know what options are. So I see there have been no responses that of no experience. So that's good. At least you guys have a general understanding of what a call and a put is, and that will help you understand what we're going to do going forward. So hopefully you all responded to this poll. Okay. So on this first slide, you could see what determines options prices. Well, if you look, most of you can look at a textbook or a video, and you'll learn that the factors that contribute to an options price are the price of an underlying stock, the strike price for the option, the time until expiration, the volatility of the underlying stock, the dividend rate of the underlying stock could be a factor depending on, if the dividend is going to come into play during that expiration, and interest rates. I would say of that list right there, the least important one is probably interest rates, because it's the slowest move. Now, interest rates are very important, when it comes to trading, but not necessarily in terms of the specific price, options pricing models, because they move a little slower. They are interest rates are more important for longer term options, because there's more of a likelihood that those can move in any significant way. Having said all that, what really moves options prices? And I can tell you as a former market maker, what really moves options prices is you. It's the clients. It's the retail investors. It's the firm, trading desks, the professional traders, hedge funds, whoever is placing the orders. The order flow is moving the options prices accordingly. So if there's a heavy demand for certain options, and I'm, as a market maker, I'm 5 bid, I'll sell it to you at 530. 5 bid, 530, and people keep coming in to buying at 530. Well, why do I want to keep selling it at 530? I'd have to be crazy. I'm short, hundreds of options, maybe thousands of options, and people keep buying them. So of course I'm going to bump it up. I'm going to go to 510, 540, and then I'm going to go to 520, 550, and then I'm going to go to 530, 560, and that order flow will literally determine what the implied vol is, the implied volatility of an option. Now, having said that, yes, the stock movement also plays a big factor in that, but the most important thing is the order flow, because if the stock is moving a lot and people keep selling me options, well, I'm still going to lower the price. It's great. It's great for me. You keep selling it to me as a market maker. You keep selling it to me, I'm going to lower it. You selling it to me more, I'm going to lower it. If you keep buying it, I'm going to raise it. My job as a market maker, which I am not now, by the way, I'm more like you guys now. I'm sitting in front of my computer all day trading. But as a market maker, you should know the people you're trading against, they're moving their options prices based on that order flow. The other thing is, there are some, there are some more macro events like news. Well, let's start with more of a micro event, like news on your particular stock. Obviously, that's going to have a big effect. So if earnings is coming in a particular stock, we all notice that the volatility spikes right before earnings, and the options premiums get much more, get much fatter, much more expensive. Now that is because earnings is coming, and you're likely to see a large move in that stock one way or another. Okay. Again, having said that, if people keep coming in and selling me options right before earnings, as a market maker, I'm still going to lower that price. Why not? I can get it. If I can get it for cheaper, I'm going to take it. But that's not how it works. People generally buy options going into earnings, and as a result, time premiums, options premiums get fatter. Okay, there are also macro events, interest rates change. There can be international conflicts. This past year, obviously, we saw a pandemic, which certainly affected volatility quite a bit, and movement of the overall market. If anyone was trading today, I'm sure, hopefully you guys had a decent day today. Was not easy, I can tell you that. And I'm sure most of the things you guys were trading, you saw the implied volatility really got jacked up today. As a rule of thumb, when the market goes up, implied volatility goes down. As a rule of thumb, when the market goes down, implied volatility goes up. Okay, so let me just see. I want to just see if we have a question or two here. No, there. So Billy asked the question: are there rules for the market makers before they adjust the price, or is it solely up to the market maker to adjust on the fly? The latter, Billy. The market makers adjust prices as they see fit on the fly. Now, there are rules in terms of how wide a market maker can make a market. So for a lower price stock, and I don't, off the top of my head, I don't know what the current width is for, rules, but, for a lower priced option, maybe the maximum width can be 20 cents. And a higher priced option can be 50 cents or even $1 wide, maybe even more, by the way. I mean, I've seen some things $5 wide, some out of the money leaps, that kind of thing. Leaps being the very long-term options that go out 2 years. So market makers adjust on the fly, and you can see that in your daily trading. You could see it blow up within seconds if something happens, if a big order comes in, if a big stock move takes place. These things move around very, very quickly. Now, having said that, I've heard people say, usually incorrectly, oh, I see some things are out of line. I see that these things are mispriced. That is almost always going to be a falsehood. Market makers are extremely proficient at making their markets the correct price. Okay, it always makes sense for them. Now, there might be a time that something's a little out of whack and you could take advantage of it. For them, it makes sense, but for you, it also makes sense. Okay, and we do look for those things, obviously. We want to, there might be a situation. Let's say, for example, these meme stocks, like GameStop or AMC, where it's having a big day and it's getting jacked up from all the word of mouth and the internet. And in a situation like that, you might see the an upside skew, meaning you might see the volatility for a higher option, a higher strike option, be something like 160, and then you could see an at the money option only be 100. Which is a huge difference, a 160 versus 100. And the reason that happens is because the people are flooding in buying the upside calls. They're buying the cheap calls. So the market makers are raising the prices of those upside calls. And it's not really happening so much with the at the monies. So that's why that happens. So we can at times potentially take advantage of that. You might want to buy an at the money call and then sell an upside call, and it gives you a good risk reward ratio. It gives you a better chance of making money if that thing moves in the right direction. But of course, it always does, it always does rely on you being, correct directionally, or at least not heavily incorrect. Now, just going back for a second, that reminds me of something. I see here, when you look at my name right here, I put in quotes, I make money in spite of myself. Well, the reason I said that is because I'm often incorrect about direction, about stock direction. Yet, over the years, I have made money, and I have quite a bit of pressure to make money, by the way. I have 5 kids, I have 2 houses, I have 3 cars, and I'm sitting here in front of the computer trading, okay? I have no inside information, and that was another thing that was interesting. As a market maker, people always used to say, oh, you have inside information, it's rigged, the system's rigged. Let me tell you, the system is not rigged, and market makers are extremely they're as stressed out as you are. As a market maker, you understand options pricing better than most people, and that's how you make your money. But market makers have no inside information. Bear in mind, when a market maker trades with you, they don't get to sit around like we do all day and cherry pick and say, I'm going to sit here all day, and when I finally find my one good thing, I'm going to make 2 or 3 trades. They don't get to do that. They have to do trades with you all day. If you want to buy an option, they have to sell it to you. If you want to sell an option, they have to buy it from you. Any stock, any price, any strike, and so the fact that they're able to stay in business doing trades that other people want to do all day is really remarkable. So they do know what they're doing, and options prices are rarely out of whack. Okay, so now let me see. I might have a poll on this. I think I do. Let's take a quick look. I kind of do. I'm going to send out a poll, and if you guys could throw out some quick answers on this one, hopefully you guys can see this. Oh, Okay, there you go. Hopefully you guys can see this poll. I'll give you a couple more seconds to answer this. Don't worry, you're not being graded on this. My goal here, by the way, is to take my 35 years of options experience and frankly, just teach you guys. I really enjoy teaching. When I was at Tufts University, I was a statistics teaching assistant as a student. I love teaching. I have to be honest, a high understanding of options pricing. So I want to share that with you guys. It's fun for me. Okay, so I'm going to assume you guys are done with this poll. So it looks like there's a little bit of a split here. The question on the poll is time premium is greatest for options that are, and your choices are in the money, out of the money, or at the money. Okay, so what is time premium? Okay, that is something that we need to address. And just to give you your poll results here, it looks like about 35% of you said that time premium is greatest for options that are in the money. About 50% of you said that time premium is greatest for options that are out of the money. And about 14% of you said time premium is greatest for options that are at the money. Okay, so let me just say that the 14% answers, the people who said at the money, are the ones who are correct here. Okay, now what is time premium? Okay, and I'm going to kind of answer that by discussing what's on your presentation here: intrinsic and extrinsic values. Okay, intrinsic value is the value of the option if it were to expire at this instant based on the current underlying stock price. Okay, in other words, intrinsic value is how much is this option in the money. Okay, if it's in the money, if you have an option, let's say it's a 30 strike and the option price is $5 and the stock is at 33. That means the intrinsic value is $3 because it's right now in the money $3. But the option is priced at $5, so there's an additional $2 of premium there. Why is there an additional $2 of premium there? Well, that additional $2 premium is the time premium. And that additional $2 of time premium is what is known as the extrinsic value. It's the option premium over and above the current intrinsic value, or over and above the amount that the option is currently in the money. Having said that, an in the money option I just described, an out of the money option is all extrinsic value. It's all extrinsic. So that's all time premium. An at the money option, okay, technically at the money, I mean, I'm saying give or take at the money. That's mostly time premium as well. Okay, it might be a little in the money. It's rarely exactly at the money. But the point is that when an option is at the money, that is the time where you have the greatest amount of time premium. Okay, and in either direction, going up or down, you have less and less time premium. So if let's say, for example, an option, let's say the strike price is 30. And an option price is 5. The stock is let's say the stock price is 30 and an option price is 5. Okay, and the strike is also 30. That's all premium. That's $5 worth of premium. Okay, but if the stock is now 28, that value for that option is going to be maybe let's say $4. Okay, and that's all premium. $4 worth of premium for the 30 calls. But the at the money one was $5 worth of premium. Now, let's say it's in the money by $5. So the stock price is 35. The 30 strike is now maybe a $6 option. And that $6 option, 5 of it is the intrinsic value and 1 is the premium amount. In general, that might be a little bit complicated for you guys. The most important thing to remember is at the money options have the most time premium. Okay, now let's understand this a little bit better. First, we'll just go over the Greeks. I don't know if I did a poll about whether you guys understand the Greeks, but let's just very briefly go over it. So delta is the change in, I see the polls here, Igor, but I do not think I did. I didn't do one on the Greeks, but we'll cancel that for now. So delta is how much an option price changes for $1 change in an underlying stock. Okay. Now, if you buy a way out of the money option, the delta is going to be very low. Generally speaking, people approximate, they estimate that the delta is the percentage chance that your option will close in the money. So if an option's way out of the money, what happens is the delta is very low. Let's say it's so far out of the money that the delta is only 10. Okay. There's approximately a 10% chance that that option will finish in the money. Now, if the stock price goes up $1, your option will only go up 10 cents because it's very far out of the money. So that's what delta is. If it's way in the money, okay, and your delta is 90, if the stock price goes up $1, your option value will go up 90 cents. The reverse is true as well. If the stock goes down $1, your option price will go down by 90 cents. And for the out of the money, of course, the same thing. If it goes down $1, your option value will go down by 10 cents. Okay, this is only one factor called delta. As a rule of thumb, delta is 50 for at the money options. So if you're in a situation where you're just making, you're making snap judgments as to whether you should make a trade or not, it's good to take these things into consideration. Okay, I always consider the delta. And by the way, I am a member of Mr. TopTick, the Trader Alerts. And the reason is what I already told you. I understand options pricing extremely well, but I want to have a little bit of insight on what's going on in the market. And I want to understand, and I want to have some people to bounce my ideas off of. And I want to see other people's opinions about what's happening in the market. And they have some really good people, some people who understand markets and they understand things about stocks that I don't understand. And then I'm sharing on the options pricing piece. So every time I make a trade, I look at the delta, I look at the gamma, I look at the theta, and I also look at the various risks, risk versus reward. And based on all that, I will, maybe I will or maybe I won't make a trade, or maybe I'll take an idea that they give me on Mr. TopTick on Trader Alerts, and I'll use my own trade based on what they're indicating about what they think of the stock. So it is really important, and I think our goal is to teach. It's not to just give alerts, but it's to teach you guys the tools you need to become really good traders. And let's not kid ourselves. Trading options is extremely difficult. I don't think anyone who's traded for any period of time can honestly say that it's easy to make money trading options. It's very, very difficult. And I've seen lots of claims on YouTube and on Facebook. And believe me, anyone who tells you making money in options is easy is either lying or they just don't know what they're doing, and they haven't had enough experience to be burned yet. Having said that, you can make money, and many of us do make money. So again, this is what we're trying to do for you. Gamma is the change in delta for a 1-point change in the underlying stock. If a stock is out of the money, but then the stock price flies in an upward direction, and eventually it's going to be in the money, well, that delta goes from that low, let's say 10, to it can go, once it's at the money, now the delta is 50, and the stock keeps going higher, eventually the stock's going to the delta is going to be 90. So that's gamma. What gamma is if you own an option, as the stock price moves up, your delta is going up with it. So that's why options are so powerful. Of course, the reverse is true. If you sell an option, you're short gamma. And if you sell an out of the money call and it blows through, if it blows through your strike, well, eventually that's going to be it's going to turn into 100 delta if the stock goes high enough. And in fact, you all know if you sell a covered call, at the time you sell it, it might be a 30 delta. But by the time the thing's in the money at expiration, you're giving away your whole stock. You're giving away 100 deltas worth of stock. Okay. Theta is the amount of decay every day in your option. Now, it's very important to understand that when you own an option, if the stock price doesn't move, not only does the stock have to move in the direction you want it to move, but it has to move enough and fast enough to be profitable. If it doesn't move enough or fast enough, you're going to be caught by the theta decay, or you're going to be caught by the implied volatility going down. The option price can go down just because the stock started to move slowly. Generally speaking, when stocks and markets go up, the implied volatility goes down. And when stocks and markets go down, implied volatilities go up. Today was a beautiful example of that happening. Vols just, exploded in certain things because the prices were going down relentlessly. Okay, now this is a little more advanced, but it's important for you guys to know it's out there, and hopefully you can look at some things, look at some reading material and understand that options are really, really cool. You can take different options and option and stock combinations and create other equivalent strategies. For example, if you buy a call and sell a put, that is equivalent to buying the stock. If you look at your P&L graph, that is equivalent to buying a stock, okay? Buying the call will give you the upside of the stock when the call goes up. Selling the put will give you the downside, because when you sell a put, when you buy a put, you make money if it goes down, but when you sell a put, you're losing when it goes down. So if you guys take a little time to draw out some graphs, you can see that buying a call and selling a put is literally the same P&L chart as buying a stock. Now, usually that's efficiently priced because market makers obviously understand that when you buy a call and you sell a put, it's the same as buying a stock. So you're essentially going to get it at that stock price plus a little bit of a premium for the bid-ask spread, okay? They're going to charge you a little more because you don't have to put out all that buying power to buy the stock. You're just buying the call and selling the put. So it does, it's less of a capital outlay, okay? If you sell a call, conversely, if you sell a call and buy a put, it's equivalent to selling a stock. If you buy a call, and these get a little tricky and you should take a look at them later. If you buy a call and sell stock, that's equivalent to buying a put. So if I'm a market maker, I don't care if you buy a call or buy a put. To me, it's the same thing. If you buy a put and you buy a stock, that equals buying a call on the P&L graph. If you sell a call and buy a stock, that's equivalent to selling a put. I know there's a lot to take in, and I'm happy to take questions later, and this might take a little time for you to look into and digest, okay? If you sell a put and sell a stock, that's the same thing as selling a call. The important thing to take from all this, it's important to understand those things, first of all, but it's also important to understand that market makers are indifferent to buying or selling calls or puts. If you come in to buy a Microsoft, I'll go back to the AMC example. If you come in to buy an AMC May 14th 10 call, they don't care if you buy the 10 call or the 10 put. To them, it's the exact same thing. Why? Because if you buy the call, guess what they're going to do? They're going to sell you the call, but they're going to buy stock to hedge it. How much are they going to buy to hedge it? Well, they're going to look at that thing we discussed previously. They're going to take the delta and they're going to buy the exact amount that the delta indicates. So if you buy an at the money call from a market maker, they'll sell you that call and they're going to go out and buy half the equivalent in stock. Okay, so if you buy one call that represents 100 shares, the truth is they probably wouldn't do anything there. But let's say you buy 10 calls that represents 1,000 shares. They're going to go out and buy 500 shares of stock right there to hedge it. And hopefully, what they're trying to do is they're locking in the profit because there was a bid that was lower and an ask that was higher than the fair value. You buy the call, they sell it to you, and they go out and buy the stock to hedge it. If you buy the put, they do the same exact thing. They'll sell you the put at the same exact implied volatility, okay? And then they're going to go out and sell stock. So if you buy 10 AMC calls, they're going to go sell 500 shares of AMC stock. If they don't own the stock, they're going to sell 500 shares of AMC stock short, okay? Now, of course, selling a meme stock like AMC or GameStop is a no-no, but not for them because they own the option. So they're, they have no choice. They're taking a lot of risk. They're taking a lot of risk. So they're going to sell you the call. They're going to sell you the call, and they're going to buy some stock. And they are at risk there because they're not buying one for one. Okay, that's not your problem as retail traders. That's their problem. They have to go out and find other ways to hedge, maybe buy other calls from other market makers who own them. Whatever it is they have to do, it's none of your concern. The important thing to understand is that whether you buy a call or a put, it is literally the same thing. You will also notice when you look at an option chain that the option implied volatility is the same for calls and puts of every strike. So if you look at AMC, again, I'm not looking at the option chain right now, but at times it gets blown up. So you might see an AMC option that's $5 out of the money, that's 150 vol. The call is selling at 150 vol and the put is selling at 150 vol. Then the 12 line might be at 130 vol, call and put. The 10 line is going to be, let's say, 110 vol. But the main thing to take in is that every line has the same exact volatility. Okay. Now, again, as we discussed earlier, you might want to buy the 10 line and then sell the 15 line because the 10 line is a lot cheaper relative to the 15s, and you just bought yourself a call spread, and that gives you a favorable risk return ratio. So if it does skyrocket, you got yourself a nice little profit there with less risk, less money outlay, less on the line. Now, based on everything I just told you, there's a thing called call put parity, or put call parity, a lot of people call it. For the same stock, expiration and strike, call and puts have the same extrinsic value. Okay, so I can look at a call option, and just based on where the stock is priced, I can tell you what the put price is going to be. For example, let's say let me see if I can pull up a real option chain here. Okay, I don't think you guys can see it, but let's say AMC is trading at $10. Okay, it closed at 1044 actually. So let's use the 1050 number. Okay, so AMC closed at 1044. Okay, now I'm going to go to the front month options, the first ones that expire on Friday. Okay, I see that the 10. Okay, unfortunately this is moved after market, so it's not going to help me that. Let's just pretend it closed at 10. Okay, if AMC closed at 10, then if the calls are 50 cents, then the puts are going to be 50 cents, exactly the same. But let's say AMC closed at 1010. Okay, if the calls are 50 cents, that's 40 cents of extrinsic premium. Okay, so if AMC closed at 1010 and the call price is 50, then the put price, the 10 puts, is going to be 40 cents. All you do is you deduct the amount that it's in the money from the call price, and that gives you the put price. You will be able to find on all of your options chains, if you look at the extrinsic value of each call and each put, it'll be the exact same price. If it is not the same price, do not think that you found a glitch, because there are times that it can be a little bit different based on whether it's a hard to borrow stock. So if it's a hard to borrow stock, the puts are going to be much more expensive, because when the market makers sell you the puts, they also have to sell the stock short. It's hard to borrow that stock, so they're taking risk. It's difficult to do that. They have to pay higher interest to sell, to borrow that stock. So those puts are going to be more expensive. But generally speaking, the extrinsic value of all calls and all puts is exactly the same. Okay. Now here, this is where I really got the idea of calling this an options hacks presentation, because these are things that I've literally learned over 35 years. Most of it, I will say, is when I was a market maker. I learned most of this, but I'm always learning, always tweaking my knowledge. And these are things that you don't necessarily know right now, but I hope you will learn. And these are things that I consider every single time I make a trade, literally every single time. When we get an option alert through this particular service, which I love, by the way, when we get an alert from this service, I'll look at the trade, and then I'm going to quickly go through in my head, does this make sense for me for various reasons? So the first thing is, you should know that short-term options decay much faster than long-term options. In fact, they decay exponentially quicker as time gets closer to expiration. So if you're only a week out from expiration, your options are going to decay very quickly compared to something that's 2-3 months out. So if you're not sure when a stock is going to move and you want to buy an option, you're taking a much bigger risk by buying an option that's only a week out from expiration. So often if you feel good about a stock and you want to be long that option, which is not always even the right thing to do, by the way. Sometimes you want to be short options, and we can cover that later. But the point is, just understand that if you have a short-term option, it's going to decay. The value is going to disappear exponentially quicker than longer-term options. The next thing that I've learned over time is that at the money options, and I already mentioned this today, have the most time premium. So those, there's a lot of decay there. Now, having said that, if you look at the next bullet point, at the money options also have the most gamma. So you have the most time premium, and therefore you have the most decay, which is the next bullet point, the most theta. So you have the most time premium, the most theta, the most decay, but in return for that, you are getting the most gamma, which means that if the stock moves in your direction, the deltas are going to increase quicker, and your option price is going to explode a lot faster. So it's a trade-off. Do you have the thought that this thing is really going to move because of an event or something happening in the next day or two? If not, you're probably better off if you buy an option that's a little further out. Now, the flip side is you might be saying, well, why don't I sell options that are short-term because they're going to decay so fast? Well, you certainly can do that. But again, there is a lot of risk there, because even though you have an exponentially faster decaying premium, you also have a lot of short gamma, and someone who, if the stock moves against you, you're going to get run over. Okay, so it's very important that you make sure if you sell premium that you understand your risks and your potential returns. And that usually means that if you sell something, you need to buy something else. Okay, maybe you want to sell something that's out of the money and then buy something that's even further out of the money to protect yourself. So at least you can calculate what your maximum potential loss is. And the amount that you collect, of course, is your maximum profit. You cannot, when you sell option premium, you can't make more than you collect. Next thing is long-term options are most heavily affected by vega. Now, vega is basically what happens, how much your option price moves based on a change of implied volatility. Okay, so yes, it is safer at times to buy longer term options, but if you buy longer term options after a huge shakeup in the market, well, then you could have a problem on your hands. Let's say, the market just, crashes, it goes down 20%. Okay, now now implied volatility is huge, and if you buy long-term options and the volatility goes back to its mean over time, you're going to get crushed simply by that drop in volatility. Even if the stock is moving in your direction, you're going to get hurt by the volatility crush, and that could happen, by the way, tomorrow. Let's say those of you who bought call options because the market was down so much today, it was and you think we might get a little bounce tomorrow. Well, guess what? The time premium, the implied volatility is so big that if your stock or index or whatever it is you bought that call on doesn't go up substantially tomorrow, it's probably going to be a loser, just due to the fact that as a stock goes up slowly, or an index goes up slowly, the implied vol starts to get crushed. So that causes a situation. Boy, if I had $1 for every time I saw someone post on Facebook, I own an option and the stock went up and I'm losing money. Why is this happening? Well, the reason it's happening is because the implied volatility is getting crushed. You bought it at a higher number, at a high vol, and your stock's just not going up fast enough, or with enough magnitude to make up for the high volatility, which is now coming down because all the panic is out of the market. And that reminds me of something. Why does vol go up when the market's going down, and why does vol go down when the market's going up? Well, when the market's going up, no one's really afraid. Okay, so you don't have a lot of put buyers. What you do have, however, is you have a lot of people selling covered calls. So they're buying the stock, it's going up, and they're selling covered calls. Well, when people are selling me options as a market maker, what am I doing? I'm lowering the price. I will lower the price until you finally start buying some, because I don't want to only buy or only sell. I want to buy and sell an equal amount and capture the spread. That's what I want to do as a market maker. I'm not taking positions like you and I do here. I just want, as a market maker, I want to buy the bid and sell the offer and hopefully do an equal amount. But I'm not going to do an equal amount if I don't move the prices around in order to, make that happen. So if the stock is going up, people are selling me calls, great. You can sell me the calls. I'll buy the calls and I'm going to keep lowering those prices. I'm going to keep lowering those prices. Now, the flip side is if the stock starts to plummet, what happens? People panic. They start buying puts as a hedge. And if you're buying puts from me, guess what? I don't want to be on the line if this market crashes. I'm a market maker. I want to make money. So when you're buying puts from me as the market's crashing, I'm jacking it up. I'm jacking it up until you finally start selling me a few. Okay, so that's how it works. So generally speaking, the implied goes up when the market's going down, but the implied vol goes down when the market or the stock is going up. Now, it can be overtaken by a huge move. If it's going up and up and up, and all of a sudden, whoa, this thing's up 10%, 15%. And that just the sheer force of the magnitude of the stock move, or the fact that maybe it's feeling a little top heavy and maybe we'll get a little crash tomorrow. Well, then again, the volatility could start going up at that. So it's going down, and then finally it goes up so much, this underlying stock, that the vol could go up. Okay. Now, market makers use pricing formulas. Some of you may have heard of the Black-Scholes pricing model. It doesn't really matter which one you use. In fact, when you look at your interactive broker's account or your Thinkorswim, you probably don't even know what model you're using. The important thing is that it's the same model for all the options. It's just a measuring stick, okay? It's not correct. You'll never know what the real value of an option is until expiration, okay? But you're estimating it. And based on that, you want to buy and sell based on that. So, when you do a spread, you want to consider it. I'm not saying it's the only thing you consider, because you might want to sell an out of the money put and buy a put that's even further out of the money. That's actually a higher vol, because you're still collecting a premium. But so it's not the only thing you're considering, but it is a nice thing to consider. Okay. Now, I have a poll that I want to give you guys. Okay. And I just want to, before I give you this poll, I don't want to make this too technical, but I want you guys to understand that in addition to the risk, when you buy leaps, I told you there's a risk, okay? That implied vol could go down when the stock slowly goes up. And the Vega affects you more when you have a long-term option. And I've seen, and I'm not kidding when I tell you, I've literally seen market makers go out of business because of Vega swings, having nothing to do really with the stock, but they own too much or they're short too much, and there was an implied vol move that just blew them out. So you have to be very careful. If you trade stuff that's only 1 or 2 months out, then you're going to have much less Vega risk, okay? But of course, you will have more theta risk or gamma risk, depending on whether you buy or sell them, okay? There's another risk that you guys should know about, and very few people know about this. That is the risk of owning leaps if your stock gets bought. If you own a stock and it gets bought out, and if you own the leaps and it gets bought out, you could have a very big problem on your hands. Why? Let's say a stock is 10, okay? Let's just use the AMC example again. Let's say a stock is 10, okay? And you buy the 15 calls for $5, okay? Way out of the money, but these are leaps. That's why they're $5, okay? Now the stock is 10. You paid $5 for a 15 strike option. That's 2 years out, okay? Now in 2 years, it may very well go up there, but let's say someone comes in and says, AMC, we're going to buy this thing. We're going to reorganize. We're going to make some money, and we're going to pay a huge premium. It's $10 now. We're going to pay a 50% premium. We're paying $15 for this thing, and now they're part of our company. Guess what? That $5 you just spent for 10 options, poof, it turns to zero because they bought it for $15 and you had a 15 strike. Okay, so when a stock gets bought out, all the time premium that was supposed to last for 2 years gets knocked out of your option within a couple of days. Most of it as soon as the announcement comes out, by the way. Okay, so it's very risky. Make sure if you own leaps that you buy them when the implied volatility is low. And second of all, make sure that the stock that you're buying a leap in is not a potential buyout target. Okay, so yeah, maybe if it's a really big stock like Apple, you don't have to worry about that. But if it's a smaller stock, and a lot of times you can go to their websites that tell you what kind of stocks are at risk for being bought out, or potential targets. Well, if you own an out of the money leap for a buyout and a buyout target, and it gets taken out, you just lost all your premium. Again, I've seen people lose huge money in this. In fact, when I was a market maker, there was a pharmaceutical company called Immunex. And I noticed they just kept coming in selling me leaps. They kept coming in, selling leaps. We're lowering it. They don't care. They keep selling it. Okay. Now, I told you earlier, I don't have insider information, but that was a piece of information right there. They were basically telling me, this thing's going to get bought out. They just, no matter how much I lower these out of the money calls prices on these leaps, they just keep selling them to me. So as it was happening, I kept going and selling. I'm sitting there buying them on the American Stock Exchange, and I'm on the phone calling out to the SIBO, selling them to their market makers, because I didn't want to get caught holding the bag. And by the time, and sure enough, this thing got bought out. And by the time it happened, I was actually short leaps, and I had a really good day that day. Okay, because all that short premium I had, poof, turned to zero. Okay, had a real big day that day. But I didn't, the only reason I knew it is because they kept coming in and selling them to me. Okay. Now on this page, this is really, and I don't have a whole lot more, just so you guys know, there's not a whole lot more in this presentation. But again, this is information that I've acquired over 35 years of trading, and there's so much more to discuss. And I really do look forward to the opportunity to engage with you guys. And, I know some of you are actually in the Mr. Toptic service, and if so, I would love to talk to you guys about it. And even if you're not, I'm happy to talk to you guys about options trading and options pricing, and what I've learned over the years. And believe me, a lot of the stuff I've learned is not so easily accessible, because there's no substitute for experience. And if you weren't standing on that floor, or even not standing on the floor, if you're not a market maker somewhere doing this, or a professional trader somewhere doing this, some of the stuff is not so accessible. So I will be happy to talk to you guys about it. I love doing it. Okay. Now, this is kind of the last big topic I want to talk to you about. When I say big, I don't mean long. It's going to be a short one. But if you take nothing else from this presentation, then what I'm about to tell you, it was worth your time being here. Trust me, it was worth it for you guys to be here just for what I'm about to tell you. Okay. Make sure you close your positions before expiration. Okay, hold on a second. I just want to see. I think I have a question here. I want to see if I can answer it real quick. Okay. Yeah. Okay. The question is there any risk for options that expire worthless and you didn't close? I think you just lose your premium, but any other risks by not actually closing it? Had a couple I just let expire because they were worthless, but rethinking that strategy now. Yes, please rethink that strategy 100%. And that's what I'm about to tell you. Okay. If you have a position, I strongly urge you, unless you want to get hurt. You know what? Let me give you a poll. I'm going to give you guys a poll. This is going to be fun. Let me give you guys this quick poll, and then we'll talk about it. Here you go. Let's get answers to this, and then we'll talk about what closing options positions. Hopefully you guys can all see that. Can you guys see that? Taking your time, that's fine. It's a little more complicated. Hopefully you guys aren't having bad, memories of standardized tests right now. But we don't care about standardized tests, do we? We don't care about the SATs or the ACTs. Trading is the big equalizer. Okay. No one cares what you got on your SATs. No one cares what college you went to. No one cares what degrees you do or do not have. No one cares what your race is, your religion, your ethnicity, your sexual preference. None of that matters. Okay. We only answer to the market. It's a beautiful thing. So if you guys can learn with me, And with us, that's the key. Learning about and understanding what you're doing. When you, in order to make money consistently and over a long period of time, you have to do it on purpose. Trust me. You can't say, "Oh, I winged it. Oh, wow, I made money on I made money on my GameStop calls," or you know what? Over time, you need to understand what you're doing. Okay, this is the great equalizer, and I love the market for this. Okay, I don't know if everyone has responded, but I'm assuming most of you have. Okay, so it looks like 20% of you said that you would profit $10,000. 30% of you said you would make an $8,000 profit. 30% said you'd make $8,000 profit, or profit an unknown amount, or a loss of an unknown amount. You're not sure which. 10% of you said a $15,000 profit, and 10% of you said a $13,000 profit. Okay, it seems that you guys have responded. Every response was selected here by at least a few of you. Okay, the correct answer is C. But let me first tell you. I just first want to explain something to you about the people who chose A versus B. Okay, the people who chose A, what you're looking at is you're saying that it went from, it went through 680 and above 690. Therefore, I made a $10 profit times 100 because one call, or I'm sorry, times 1,000 because 10 calls represents 1,000 shares of stock, and therefore I made $10,000. The reason that would not be correct, even if we didn't have this expiration issue, is because you spent $2 for the spread. Okay, so you don't have a profit of $10. It's worth $10 at the end, but your profit is only $8. Okay, you spent $2 and it would now be worth 10. Okay, the people who selected B are using that logic. But now, why is C the correct answer? Okay, why is C the correct answer? Okay, the reason is because an option is called an option for a reason. Okay, and and again, I want to emphasize, this is really the last topic. It's very, very, very important for every one of you guys to listen to what I'm saying now. Okay, it will save you a lot of money one day. Trust me. Okay, when you have an option is called an option for a reason. Why? Because it gives you an option. A call gives you the option to buy a stock. A put gives you the option to sell a stock. But guess what? You don't have to exercise that option. If a stock is in the money at expiration, yes, your clearing firm will do something called an automatic exercise. They will automatically exercise your option. But guess what? You don't have to do that. You can contact your firm and do a contrary exercise, meaning that you do not want to exercise that option even though it closed in the money. Okay, so now let's go to our example. Tesla's trading at 650 or whatever. Okay, the day of the stock being added to the S&P. Real example, by the way, and that should make this even better because this is a real example I'm giving you. Okay, thank God I'm not the person who did it, but someone else did it. They bought the spread. 680, 690, hoping that the stock would, because of this addition to the S&P, would blow up and go over 690. Sure enough, the final print, 695. Woohoo! Okay, made $10. Made $10 on it. It's worth $10. It was a $2 investment. Beautiful thing. Made 4 times my money. Okay, not so fast. You own the 680. You're automatically exercised. You didn't close the spread. You're automatically exercised. Now you own Tesla at 680. How about the 690 you're short? Did you sell Tesla at 690 to lock in the 10? You think so, right? But guess what? The guy on the other end who bought those 690s from you, he's a professional. He's a market maker or another professional. And he's saying, you know what? I'm not going to sell you the stock at 690. I'm not going to buy the stock from you at 690. You know why? Because after the close, the thing plummeted and it was trading at 650. So why the heck does the guy want to exercise that option and buy that call from you at 690 when he sees with his own 2 eyes 2 minutes after the close, he can buy that stock for 650? Okay. So now you're on the hook for a stock. You own Tesla at 680 and the thing's trading at 650. Now you lose sleep overnight because you know what Tesla is, right? Because you own 1,000 shares of Tesla at 680. You own that. The guy who owned the 690s didn't exercise. Now you're sitting there you're sitting there with 1,000 shares of Tesla at 680. Okay, that's ugly. Okay, and the thing's trading after market hours down $40. Anyone want to cry? Okay. By the way, that 680 is $680,000. So all of a sudden, lucky you own $680,000 of Tesla. Okay, assuming your firm even let you do it. Now you have to go to bed and pray, basically, that this thing is going to go up overnight, and I'm actually going to make money on this spread that I should have made money on. Okay. The next day, of course, Tesla goes down. The person ended up covering at something like 660. Okay. They lost $20,000. Okay. On a spread that closed $5 in the money, they lost $20,000. And you know what? They were lucky at that. Okay. After the thing was added to S&P, who knows what Tesla could have done? It could have traded down to $600. No problem. No problem. It was coming from 400, just a month, at the time of the announcement. So does this happen? Yes, it is a real life example. It happens. It happens all the time. Professionals you have to assume that any time you do a trade, that there's a professional on the other side of the trade who is going to make a rational decision as to whether or not they want to exercise their option. Okay. Having said that, memorize this. If you own a call and it is in the money, you have to close it unless you want to own that stock. Okay. But I'm assuming you don't want to do that. You need to close that out. If you own a call that is out of the money, that's the only one you don't have to worry about. You don't have to close that. It's out of the money. You're not, if it closes out of the money, your firm is not going to assign you and make you buy the stock. It doesn't matter. Okay. But as a rule of thumb, I just close everything. It's easier. But the only thing you don't have to close is something that you own that's out of the money. But if it's in the money, unless you really want to take assignment on that and you want to own that stock, you better close that option. If you are short an option, I don't care if it's in the money or out of the money, you got to close that thing, okay? Because you got problems. You don't know if the guy on the other side is going to exercise his option or not, and you don't know what that stock's going to do after the close. So you better just close every option that you're short, whether it's in the money or out of the money, and I don't care by how much, okay? Very, very important advice. Great talking with you guys. I can, take a few questions if you want. I just wanted to mention some recommended reading. This is stuff that I did. I'm sure there are other great resources. The first one is Options as a Strategic Investment by Lawrence McMillan. It's kind of like the options trading Bible. I think it's a great resource, and it will teach you just about everything you need to know about trading as a retail customer. On a slightly more advanced level, Options, Volatility, and Pricing by Sheldon Natenberg. That one is more of the kind of thing that professionals read, but it will give you the insights on how implied volatilities move around and how option prices move around. And believe me, on a day like today, I was trading like a nut today. And the only reason I had the conviction to do the trading that I did today is because I understood what was happening. I understood what I was doing every step of the way, and I understood what was affecting the options prices and making them tick. And without that, I think I would have turned off my computer and started crying today. But it ended up being believe it or not, it ended up being a decent day for me. And that was all about understanding. That is what I'm talking about when I say making money in spite of myself. I didn't know what I was doing. I didn't really know what the market was doing. It seemed pretty clear it was going down, but that can hurt you in a lot of ways as well. Anyway, Igor, I think we're done with the presentation. If anyone wants to ask questions, I'm happy to attempt to answer them. Hopefully I will be able to answer them. Igor, do you have anything you want to share with the group?
Thank you so much. This was great presentation, and the amount of information and the slides that we just saw, we could talk about this for months. There's so much more to it. And, as I mentioned before, we do run a service, and I want to quickly just talk about it real quick. And one of the reasons why we have a service is not to, send out a bunch of trade alerts. Hopefully somebody is going to follow blindly and make some money. That's not our purpose. The purpose of our trading service is to help people understand how options work, what makes an option go up in value, what makes an option go down in value, and how to take advantage of some of the Greeks, what we just talked about, the theta decay, if you want to be a net option seller, or if you want to play the long gamma game, looking for sharp moves up or down. We have a directional trading service, Active Trader Pro. We run the service. We share our trades with all members in real time. Probably the biggest value of the service is having the ability to log in. We do run a chat room, which is run on Slack. You're able to connect with other traders. You could ask questions. You can get good ideas. You could bounce off ideas of other members. And more importantly, I think having access to people that are doing exact same thing. We're in the markets, professional traders, all after the same goal. And you are able to ask questions and get answers in real time. I think that is the biggest benefit that you would find in our service. I did say that we will have a special offer for those that are sticking around. So I'm going to share the offer now. The regular price for our membership for the service is $149 a month. If you do want to try it for 7 days, there's no obligation. You can try it for 7 days. It's just $7. If this is something that is going to work and help you, that's great. You can stay on and be a part of our community. If not, there's no obligation. You can cancel at any time. With the service, you will get 15 to 20 trade alerts per week. Sometimes there's more, sometimes there's less. There's a lot of trade ideas that are flowing around. We also highlight some unusual options activity when we do see it. Some trades could be as short as a couple of hours to in and out day trade or so. Some trades I've published a number of trades that have lasted more than 2 months. So I tend to focus more on swing trading rather than scalping or day trading. We have a number of other members that share their trade ideas, entries, and exits, and you're able to ask questions about those trades as they come around. As I said, we do operate as a group, so it's not one-on-one private messaging, and we do mentor our members. We do it in a group setting. Everybody is part of the team. We do well together. And there are days when we don't do well. And again, we don't do well together. But for the most part, the goal is to educate, to help people. We talked about a lot of different things tonight. And this is the kind of conversation we want to carry on with our members to kind of really dig deeper on all of these topics about the Greeks. I mean, the Greeks by themselves, we can talk for weeks, right? And you don't really understand what you're doing unless you understand how Greeks will affect your positions. So if you are interested to join a community with like-minded traders, the offer is out there. You can try our service for 7 days. It's just $7. That is probably the most defined risk trade you can take. Worst case, if it doesn't work out for you, if you don't find a value, you're out $7. I mean, you probably lose a lot more going and trying to chase out of the money calls tomorrow morning looking for a bounce. But if you are looking to take trading a little more serious and you actually want to learn how we do things and how we trade as professionals, I think that you will find a lot of value in the offer that is in front of you. With that said, if you guys have any questions, please put them in the chat. I saw there was a question from Billy, and I think that this question is a little open-ended, right? The question was, is there any risk for options that expire worthless and you didn't close? So we don't know, because we don't know if you're a long or you're a short option. Like if you're a long options and they expire worthless, you don't have any risk, because you as an option owner, you get to choose whether or not you want to exercise and actually take the stock if you're long calls, or sell the stock if you're long puts. But if you're short a call and the stock, or let's say the stock, let's say you have Apple at, and the stock's trading at 100 and you're short 105 call, the stock closes at 100. But if there's news after hours on a Friday of expiration and the stock is at 110, you can still get exercised after the close. So I think that Alan makes a great point that even if you are short a call, at 105, stock's trading at 100, and that call is trading for a nickel, with minutes before the close, I would personally close that for a nickel and pay the commission. Well, most brokers won't charge a commission for anything less than a nickel, but I would still close out this position to avoid running into a position where stock shoots up on some news after hours, then you end up short stock coming in on Monday. So again, if you're long options, you don't have the risk because you get to decide whether or not you want to exercise. But if you're short option premium and it looks like an option is going to expire worthless, you still have the risk of something happening after hours. We've seen FDA announcements, some kind of news hit the wire, and all of a sudden, stock that looks like expired, or an option that looks like expired out of the money, all of a sudden goes deep in the money, and you are in trouble coming in on Monday. So I hope that answers your question, Billy. We're going to hang out for just a few more minutes, guys. If you have any questions, feel free to ask. If not, we are going to wrap this up, and I do thank each and every single one of you for taking the time to come out. Thank you, Alan, for this great presentation. I think there's a lot of information. Even for somebody who's been doing this for almost 20 years like myself, there is a lot of good information, and we're just scratching the surface here on the topics that you have briefly touched on. I would like to open up the conversation within our group and talk more about some of the more advanced topics and really understanding, helping people understand how options work, what makes them go up and down in price, what affects option pricing, and so on and so forth. So I think that going forward, I think that we're going to have a lot of good conversation.
Thanks, Igor. Appreciate it.
All right. So I'm going to assume that there is a slight lag, and I don't really see any questions coming in. We're going to give it another 2 minutes. We're going to wrap this up. I believe that recording should be available. I will post the recording for this webinar. And for those that were not able to join us tonight, hopefully we'll be able to catch a replay. Again, thank you, everybody, for coming out. Thanks for your time. Hopefully you learned something, and we'll look forward to speaking with you soon. Question from Anthony: would your service fit a person with a full-time job? I think the answer is yes, always, because as I mentioned, I don't focus on day trading as much. Some trades work rather fast, and there's an opportunity to take profits same day. Well, I'll go ahead and do so. But for the most part, trades that I take and trades that I focus on, they have 45, 60 days until expiration. They're slower moving option positions that I take. So I do think that anybody with a full-time job, that, if you have a stock, like for example, Apple, and you're looking for Apple to move up over the next couple of months, you don't have a window of the next 15 minutes to take a trade, or else the trade is gone, right? So positions that I focus on, or trades that I look to do, they have a wide window of opportunity, that if you don't enter the trade at 9:30 in the morning, you can still come back and take the trade later in the day or the following day. And I think the focus, what I do, is more or so on managing the position, right? If I took a trade, I want to explain why I took the trade that I took, what I'm seeing, what I'm expecting, and when I make adjustments to this trade, I also leave my notes and comments. And I think that's where our members actually learn the process, right? You see how the trade evolves from start to finish. So it's not so much chasing somebody else's trade alerts. It's more about following the process and understanding what I'm doing, when I'm doing it, and you get a chance to ask questions and get answers in real time. Awesome. I'm glad that this answers your question, and I look forward to seeing you inside. Again, no pressure. We're not here to pitch you on something that you may or may not use. The offer is to try our service it's a 7-day trial. I don't know if this is enough time to learn everything in 7 days, but you definitely get a feel for how we operate, how we go about the service on a day-to-day basis. And from there, you can decide whether or not this is something that you're going to use, and whether or not this is something that's going to help you become a better options trader. So with that said, Alan, thank you very much. Thanks for your time. Great presentation. And we're going to jump here. Have a good rest of the evening, everyone. And we'll talk with you next time.